This week's market behavior reveals something profound about human nature under uncertainty. When Trump threatened European tariffs over Greenland on Tuesday, the S&P 500 and Nasdaq both turned negative for the year within hours. By Wednesday, the threat was withdrawn, and markets recovered. The speed of this whipsaw tells us everything we need to know about how fear operates in modern markets. Here's what most traders missed. This wasn't about tariffs or Greenland. This was about the sudden realization that policy can be weaponized unpredictably. The human psyche shifted from pricing growth to pricing chaos in real time. Even when the threat disappeared, the memory remained. Participants now understand that volatility is a structural feature, not a temporary bug. Look at the sector rotation. Energy outperformed as Iran tensions elevated oil prices. Financials collapsed when Trump proposed capping credit card rates at 10%. Goldman Sachs fell nearly 4%. Wells Fargo dropped. These weren't fundamental shifts. They were behavioral responses to regime uncertainty. The market is no longer optimizing for returns. It's hedging against arbitrary intervention. Intel's 17% plunge after weak guidance shows how binary thinking dominates high multiple environments. Meanwhile, Nvidia and AMD surged on rumors that China might allow domestic firms to order AI chips. The same companies that were untouchable last month became toxic overnight. This is herding behavior accelerated by algorithmic execution. Capital flows to perceived winners with increasing velocity, while laggards get abandoned without mercy. The VIX compression from 21 to 16 within days demonstrates how quickly fear gets monetized and discarded. Retail traders now view volatility spikes as buying opportunities rather than warning signals. This Pavlovian response to dips has created a market structure where corrections are shallow and brief. The system has trained participants to buy fear, which paradoxically makes deeper corrections more likely when they eventually arrive. Gold hitting fresh record highs while equities trade near all-time highs is the most important signal in the entire complex. When the ultimate fiat hedge rallies alongside risk assets, it's not risk-on behavior, it's debasement protection. Silver gained 42% year-to-date, platinum up 35%. Central banks continue structural accumulation while geopolitical instability drives safe haven flows into hard assets. The bond market tells the real story. 10-year yields holding near 4%, while the Fed signals a pause means the market doesn't believe the terminal rate is as low as officials project. The 2-year at 3.5% prices minimal easing through this year. This is a market that believes the Fed is done cutting but not ready to hike, a narrow equilibrium that can break either direction. This creates an exploitable pattern. The system rewards those who understand that policy volatility is noise, not signal. History shows humans consistently overreact to threats that are floated but rarely executed. The Greenland episode was a stress test that the market passed. Prices dislocated, fear spiked, then capital reallocated once the threat dissipated. This is anti-fragility in action. The Stoic approach is to recognize that markets are functioning exactly as they should under elevated uncertainty. Participants aren't irrational. They're responding to incentives created by policy unpredictability and structural liquidity. The week's volatility wasn't a breakdown, but a feature of a system where information arrives in discrete, high-impact bursts. Second-level thinking means understanding that the divergence between equity performance and sentiment indicators reveals a market that's structurally long but emotionally hedged. The crowd reacts emotionally to each policy announcement. We remain disciplined, recognizing that execution matters more than headlines. The earnings season ahead will determine whether current multiple expansion is justified. The market is pricing perfection in mega-cap tech, assuming AI spending translates into revenue growth. Intel's collapse serves as a warning. The bar is high and the margin for error is zero. The discipline is in holding both growth and chaos positions without allowing either to dominate. The market is pricing both outcomes because both remain plausible. This isn't bearish, it's prudent. The gold rally is the market's way of saying it doesn't fully trust the system while still participating in risk assets. If you value systematic thinking over emotional reactions, subscribe for frameworks that exploit human predictability. Download the complete Stoic Market Exploiter framework from the link below. It's free for those who understand that discipline beats emotion every time.